there's a perception sometimes that this would be a really heavy lift, and maybe, maybe we have 75 employees or something like that. Does this mean we have to go hire 15 more to sit in Berlin? And, what's the OpEx and how are we going to manage that? Definitely does not need to be the case. We've had examples where, extremely light touch, managed remotely, big margin revenue just sort of shows up, and now you're relevant and present in that geography. Like anything, it's just something to be balanced on the roadmap. When is the right time to sort of dip your toe in, at what scale, and how does that balance against the other priorities? But it's without a doubt not something that you can't be thinking of before you're sort of multi-billion valuation or have, thousands of employees. I mean, it's very, very navigable, even at the earlier stage.
Hey everyone, this is Prashant and I'll be host for the VC 10X podcast. And today we have Jack Leeney with us. Jack is a co-founder and managing partner at 7GC, a venture capital firm with a unique cross-border approach, bridging the innovation ecosystems of the US and Europe. Before co-founding 7GC, Jack was at the forefront of some of the most iconic tech IPOs of our time during his tenure at Morgan Stanley, including Tesla, LinkedIn, and Facebook. In this episode, we talk about 7GC's unique investment philosophy. How and when should US startups think about expanding into Europe? Evaluating growth stage companies and valuations. The transition from startup to scale-up CEO. Leveraging AI in portfolio companies and venture capital, and lots more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast 10X, where I help venture capitalists, asset managers, allocators, and family offices in starting their own podcast and building a strong brand. Podcast 10X is designed in a way to work well with the busy schedule of investors, where we handle every aspect of podcast production so you can focus on investing. If you're looking to build a strong investor brand, starting a podcast should be right up your priority list. It's the only form of marketing where you can showcase your strong network, in other words, access to limited partners and founders, and grow that network further. And contrary to what most people hear, it's still very early to start a podcast. There are at least 10x more newsletters and 1000x more blogs than there are podcasts in this world. You can learn more about our podcasting services at podcast10x.com. I'll make sure to add the link in the description below. Enjoy this episode. Hey Jack, so good to have you on the VC 10X podcast. How are you doing?
Yeah, good. How are you?
Very well, thank you. So good to have you here. And to start things off, can we start with what inspired you to co-found 7GC, and how does your investment philosophy differ from other growth stage venture firms?
Sure, absolutely. So, I spent pretty much my whole career working in Silicon Valley, initially as an investment banker at Morgan Stanley, and that was up until about 2011. So before, during, and after what was the financial crisis. But when things cooled down and markets opened up again, was really exciting time. So we worked with Tesla on their IPO, and Facebook and LinkedIn, and essentially all these now household names, but were some of the biggest venture-backed companies at the time. So I was always quite interested in, moving over to the investor side and working there. And I had worked for a fund in Palo Alto kind of for a brief amount of time, but then I had an opportunity to set up the corporate venture group for Telefonica. So, one of the biggest market cap companies in Europe, large telco, cable TV, sort of diversified comms business there, but really primarily across the operating businesses in most of the countries in Europe, and then also in Latin America, with no presence in the US. However, they were very interested in investing around, at that time, what were hugely disruptive forces to traditional telcos and infrastructure providers. I mean, everything on social or on consumer was going to social, local, mobile, as they used to call it, and then the whole enterprise was being reimagined with cloud shortly thereafter, and then all those sort of cybersecurity needs, et cetera, et cetera. So it was a really exciting time to invest, and I was largely, U.S. person in California, local network, swimming in that pond, but now representing this massive organization in Europe, and also not only being able to invest on behalf of them, but be able to deliver to founders and management teams, this opportunity to launch and distribute in the European market with a huge customer there, and that was a pretty light bulb moment for me. That was a way to really have a bit of a differentiated conversation with the management teams we were working with. It's often the thing. It's similar to what we do now. At the stage we're investing in companies, uh, they're by and large doing extremely well. They've attracted a lot of venture money. The secret's out, whether it's a Series A scaling or even a later stage thing. But they're often not really thinking in earnest about international yet, and Europe is really the most logical place to think about first. But it's very nuanced, and so to be able to kind of come in and sort of walk through that, have the ability to do commercial partnerships pretty easily, demystify a lot of it, help people just think through, how much is this going to cost me? Do I have to hire 20 people? Can you do it really frictionless? All of that nuance is specific to the business, specific to the segment they're going after. And you can really help people if if you have basically a track record of doing it, but also the right partners to catch the ball on the other side. So that was a good bit of the inspiration for me, or what I thought was, in an ever competitive venture capital market, something that a firm could really deliver as a value to ultimately stand out, but also actually, have that translate into real equity value in the companies you're working with. So that was a good bit of the early thesis among a number of other things, and I'll fast forward a bit. But what we've done really since launching and starting to investing in 2018 is sort of build those investment networks in both areas. So the vast majority of the LPs in our funds are European, and the majority of the investing activity we do is in the US.
Right, that's quite interesting, and giving this opportunity of U.S. founders and U.S. startups sort of expand into the European market. That's quite interesting. And when you're doing that, at what stage of a startup are they, in your opinion, ready to expand into other regions, and why Europe can be a good option for them at that stage? And then, what is the specific kind of help that is required in helping them set up into a different market, and maybe the European market? Also, for the founders who might be considering that, what are the key considerations that they should be mindful of while doing that?
So it's definitely nuanced to what the company is doing and what sector of the real economy, I would say, they're ultimately selling into. So all of our investing is software. It's all marketplace and SaaS business models, but generally asset light software businesses. That being said, the underlying sectors we look at or have invested in is really varied. We've done these days we're very heavily involved in more infrastructure level AI, but in the past we've done health tech, real estate tech. We've done things that are I guess media and gaming and kind of entertainment related, and it's been varied. And I would say first and foremost, from a suitability point of view, you'd have to just think if you are matching an existing regulatory framework. So what does that really mean? In fintech, in insurance tech, in things that are touching the healthcare system, whether it's all the way down in the payers and the hospitals and the insurance providers, or a completely, more direct consumer surface level approach, those nuances may be quite unique depending on what the regulatory environment means in the US versus Europe. And the differences there can be quite obvious. But depending on what you're doing, if it's peer-to-peer lending, that just might not simply translate in the UK or in France, or it may need to be, the go-to-market might need to be adopted. So I think first and foremost is, understanding the applicability. Um, and let's just say you're in a space that is heavily regulated and may require a whole different host of licensing or approvals or red tape, or for whatever reason, it actually does look a bit tough to kind of smoothly enter the market. That doesn't mean don't do it. There's great examples of insure tech companies, actually, specifically, that have essentially taken the software, the product offering that they've built for the US market and done white label licenses or exclusive licenses to, one company in the German market, in the French market, in the UK market, whatever it may be. And that could be a very appealing sort of 100% margin source of revenue to think about. And we've seen great examples of that in the past. On the opposite end of the spectrum, you may have a very frictionless business model that would translate immediately. And maybe there's even a competitive dynamic with the European venture market has gotten way more robust in the last 10 years. There, you could be the billion valued US based company approaching this, and there could be sort of some series A or B businesses in Europe that are getting pretty close. And you may just want to go, run at them on the field. And if that's the approach, so I mean, in the approach one, let's say the heavily regulated environment, the best way to be helpful if you wanted to do a really light touch kind of licensing type deployment, I mean, that's just going to be predicated on, can you connect management teams with the right sort of senior management teams at an incumbent or maybe a low tech, high value sort of publicly traded version of that. And so we've definitely done a lot of that historically, where just directly through our LP base, we can connect dots quicker. We can help you understand how to think through a commercial agreement. Culturally, these things are all a bit more nuanced. But that's pretty plain vanilla. If you were in a sector where you're not going to be facing that obstacle, and it is more ultimately go compete directly, then I would just think, I mean, Hims is probably a great example of a company from our fund one, where we did a lot of work with them. Hims is now 10 billion, give or take, of value, publicly traded company. We were investing in them at the Series B. And even at that time, they were growing explosively quickly. They were the second quickest company at the time to hit a unicorn valuation behind Slack. And they were, the customer acquisition strategy was pretty straightforward, or these days what we would think is pretty straightforward, is a mix of omni-channel media, digital and offline. And for someone like them, speed to market and just being able to buy like absolute volume, large scale ad campaigns through broadcasters, media companies, etc. I mean, that just the sheer size, the size and the approach, that'll help you get to the market quicker and ultimately reach the consumer quicker, and hopefully knock out some of your incumbents quicker. And that was a lot of work we did with them at the time. But you know to put a pin in it, I think it depends. It's a toolkit to think through with a different set of partners, depending on, all over the companies we've partnered with are all software. They're all, in some way, shape, or form disruptive, or there's an incumbent, there that has probably controlled what is a market or a combination of markets in the past. And so, we're looking at a business that's an asset light solution to whatever the problem is. How they sell through, how they partner, how they deal with the regulatory framework. I mean, all those things have to be navigated, and we just have a background in doing that, and we have the partners in our fund that can again help catch the ball if that's relevant. And maybe just the last piece to your question, when is it relevant? I think it totally depends. There's a perception sometimes that this would be a really heavy lift, and maybe maybe we have 75 employees or something like that. Does this mean we have to go hire 15 more to sit in Berlin? And what's the OpEx, and how are we going to manage that? Definitely does not need to be the case. We've had examples where extremely light touch, managed remotely, big margin revenue just sort of shows up, and now you're relevant and present in that geography. So I think it, like anything, it's just something to be balanced on the roadmap. When is the right time to sort of dip your toe in, at what scale, and how does that balance against the other priorities? But it's without a doubt not something that you can't be thinking of before you're sort of multi-billion valuation or have thousands of employees. I mean, it's very, very navigable even at the earlier stage.
Absolutely. And talking about HIMS that you just mentioned, I think they're operating in that intersection, health and wellness industry, right? How much of a regulatory difficulty was that to set operations in Europe? Uh, while also give me context of if a startup wants to go and set operations in Europe, Europe is not one country, it's one continent, right? So a group of countries. Does that mean that you need to comply with different regulations of different countries, right? And how cumbersome is that? And different strategies of go to market, maybe in different countries also because of different consumer behaviors in different markets. Is that also something that you see?
Yeah, I mean, the regulatory piece is hugely important, and with them specifically, the telehealth is definitely a newer topic, sort of everywhere, let alone across Europe. And the UK is no longer formally part of the EU, but even within the EU, there is not a uniform sort of regulation today around telehealth. So, where we spent most of our efforts at the time, as they were thinking about it, was really with the UK and Germany. And the UK was more, I suppose the right way to describe it is a lighter touch, or a bit more open to telehealth platforms delivering solutions to consumers. The insurance, the collaboration with the NHS and the insurance system in the UK is pretty strong, and they're very involved in policy, et cetera. And NHS had uh, gone through their framework to sort of allow payment for this, which is different in the US. The vast majority of the US customers and prescribers to telehealth services are usually paying out of pocket, if not maybe in a employee benefit plan that corporate is, but it's not a subsidized thing here in the US. It is subsidized and accepted in some countries in Europe. In others, in Germany, especially at the time when we were looking to do a pretty meaningful full launch, the regulatory environment was very vague and uncertain as to how and when what would be allowed, or even what types of, to sort of what level of specificity or specialization of a doctor could you consult with digitally. Could you see your GP? HIMS is very famously, and they're prescribed drugs, but they're a little bit more personal or wellness oriented in nature. You're not going through them for a cancer screening, right? It's a little more self-directed, a little more cosmetic in nature, more sort of personal wellness, et cetera. But that has to, even if that is your business approach, that has to solve with what the regulators allow you to do. So, essentially, we had an easier path with the UK versus Germany and some of the rest of continental Europe, as it was more being defined, and that was more as the company was in its earlier stages of scaling up. I mean, a lot of that has evolved now, and they've got a pretty big footprint in Europe, and they've even acquired companies there too. So
Right, absolutely, quite interesting. And even when you're launching in Europe, are you targeting some key markets or key countries first before looking at others? Like you mentioned, Germany, UK. Are those the first ones that you target to launch in before expanding into other countries?
I think in general, you'd hopefully want to match market size, GDP, average income. What are the kind of key customer demos that should translate into the best audience. If it's a consumer specific company, it's all going to have to map back to the cost of acquisition. And so if there is, if you have to spend on marketing in a certain geo, essentially you're going to look to where the best yield is. So I would think in general, map back to the largest GDP. And the best sort of consumer segments for consumer offerings, and to flip it on its head, I think with enterprise opportunities, it can be totally wide open. And ultimately, who your channel partner is for a great enterprise opportunity, hopefully they have great coverage across the EU, or even um, more broadly internationally. So again, always kind of a nuanced thing, but I think it sort of comes down to a cost benefit analysis per country, and where can you reach the most customers, but also the highest yielding customers.
Absolutely, makes sense. Great. So you're investing at growth stage mostly, and when you're making these investments, what are the key things that you're looking for in these companies? It can be in terms of like growth rate or quality of the team, or any other things that you look for while investing in growth stage companies.
Sure. Our base. So we'll. I think everyone has their own definition for growth. It's all a little amorphous, depending on who you ask for. Our minimum criteria and what we're really looking to see is has the business gotten to kind of this $10 million run rate at least yet? So we've been able to find that at Series A, which is incredible when you can, and sort of partner with teams at the earlier end. And then also we've done much later stage things. They're for us, broadly speaking, the businesses are between 10 and 100 million for it to land in sort of a first cut of our funnel. Um, all the things we've done are all software, all asset light. That's kind of the lens we look through. We want to back scalable software solutions, things that are emerging at a trend that has the ability to capture a huge amount of market share. And we've been pretty flexible around the underlying markets or underlying parts of the real economy it sells into. But just from a more kind of financial analysis, that's roughly the scale. We're looking for big gross margins. We really are trying to solve for at entry the part of the risk return curve for us to jump in and make sense. So what do I mean by that? If you have 10 million in revenue, or if you've got five in the bag and there's contracted line of sight for within a year to hit 10, what that really means to me is the tech risk has now gotten extremely minimal. The products and go to market risk has also been pretty articulated. And if we're seeing relatively high gross margins at that stage, it should mean they should only go up. So a huge amount of the analysis is the sector, the trend, the subject, what exactly they're doing. Do we believe the TAM here is sizable, or is it combining two other TAMs that we think could be huge, if they're doing something truly new and novel. So can it get big enough? Can we find the company at the right stage where they're playing in the right sandbox? And then, without a doubt, a competitive analysis. I mean, we absolutely do believe a tremendous amount of the market value from a venture investor's point of view, goes to the top two, maybe top three, within a specific segment. But that being said, we try to be very flexible about where innovation can come from, what markets are ripe for shaking up, how ultimately can that value be created. And we think if we enter at that stage where again, a lot of the tech and product risk is sort of taken out and it's coming down to team and expansion and market, then a tremendous amount of it for us comes down to ultimately, are we underwriting something that can deliver the return profile we're looking for and the liquidity timeline we're looking for. So we're without a doubt very sensitive to entry multiples. We will be, the way we run the portfolio is sort of 12 investments per fund, give or take. And that can mean we could do 5 in a year. That can also mean we could do none in a year. So I have an incredibly strong belief that despite where, the market is, if you're underwriting the things that are just priced on hubris, or a situation where, maybe this set, like we'll pick on sort of the zero interest rate period. If you were just paying those multiples for vertical SaaS, which were kind of non-differentiated widgets in a hot trend when a ton of money ran in, the market was pricing anywhere from 30 to 60 times. And you're sort of seeing that again in agentic AI companies right now. That multiple will just never make sense. There's no world where you will continue to see that hold at that level, even if the company at like the fundamentals, just the core financials, even if you were in the thing for 4 or 5 years and it doubled every year, it's just not going to look like that on the other side. It'll never be supported from an M&A point of view, and I mean, you'd have to be in a market of extreme hubris for the public markets to support that multiple at that time too. Maybe they were at the underwriting. Maybe everything was priced to the moon, public and private, at the underwriting. But at the end of your hold period, it won't. So we try to be extremely sensitive to all those dynamics. And it could be the best, and it could be really frustrating because the team could be great, the opportunity could be great, the market could be great, the company could be absolutely positioned to win. but the current valuation mismatch is just too dramatic for it to ultimately, get to a place where A, I have confidence it will get liquid, and B, when it gets liquid, what will the valuation support be like there? So that's a huge amount of our thinking for something to make sense. You really have to. There's sort of so many unknowns and so many variables you can't control as a minority investor. Um, you can control how you buy and what things look like at the entry. So you're at least setting yourself up for success on the other side.
Right. Yes, absolutely. And how would you define reasonable valuation multiples? I know it would be different for every startup, but what's the range that you like to stick to?
I mean, that's a tricky one. It depends. It totally depends. There is and the market swings both ways. We're just coming out of what was a pretty healthy reset. Um and maybe it's best to give an example. I think it's helpful to anchor on public market multiples within very similar business models. So you can always look to, where is the highest growth scaled SaaS trading, and you'll see something between 15 and 20x forward. Um, but it's never comparable at the end of the day. Why? Well, one, preference stock is not the same as common stock, and the corporate structure matters. It very much matters in a liquidity event. So your apples and oranges from the start. Second, a company that is multi-billion in scale, or even if it's not, even if it's hundreds of millions of scale, is just a very different animal than a young company that is kind of getting to that 0 to 100 million benchmark, iterating. Margins are moving. The sort of the headcount is moving dramatically. Sales channels and sales cycles are either new channels coming online, cycles are tightening, evolving. You don't have enough duration to to match the two assets and value them evenly. And last but not least, the private one should have a growth rate well in excess of 100%, and the public one is, best case scenario, probably growing at 25-30%, and that's incredible. That's a fantastically run large scale company. So that's a decent line in the sand to just sort of start from, to say, all right, at scale, or if the thing we're looking at now gets to scale and all things were held equal, maybe this is what it could look like. So let's translate the fundamentals back. And if we said this is an exit multiple today, we can look at, um, put that as an entry multiple and just say, what do you need to believe for sort of core fundamental business growth? That's too oversimplified, though. Nothing works in a straight line like that, or can be forecast and have defined entry and exit periods that clearly. But it's a decent place to start. And the others are, what you can garner from what is going on within private market activity. But the reality is, unless you're talking about the sort of top 5 companies in any given trend. And let's presume it's also a trend that is currently in favor, active, and there's enough deal volume to be able to look at a bit of a sample set. You know, those multiples are completely driven by investor and founder tension and just scarcity of capital. Um, if it's agentic AI, there are people currently happily paying 60 plus times forward revenue there. And that's where that's going on. And there's a lot of activity. There's a lot of activity to support it. Um, doesn't mean it's right, but it's another line in the sand. And there are recent paid prices, in a market with enough activity to sort of, if you're looking for that valuation, you can point to all the other ones that are doing it. And then it just comes down to competition among investors. What are people willing to believe to basically have a seat on the bus? Um, but if you take it, or take the opposite side of that, um, look at a sector that is out of favor, or not the most active, or maybe even worse, was very hot and now has kind of come back down to earth. That's a completely different dynamic on setting a multiple, or what are your expectations. And You can put whatever kind of financial analysis you want around it as the starting point for a conversation, but the reality is if the company is doing well and you're looking to partner with them, partner with their existing investors, um, and maybe give credit for what they've done between the last round, you're really thinking about what do I need to pay that is a fair premium between the last round and now, and how does that translate into a realistic multiple? If there's no bid, you can theoretically do whatever you want. And we saw opportunities in really young companies when the market reset pretty dramatically in kind of 22 and 23. We saw businesses that were at the Series A level. They were doing incredibly well. They basically had better founders that had been through situations like this before, who could do more with less. And they had built, on what we would call like seed round capital. They built a really nice sort of early stage growth business. Um, you could partner with those folks at, two, three, four times revenue. Not uncommon at all. There just wasn't much of a market or much of a bid, as most investors were dealing with a lot of the hangover of their COVID portfolio and their zero interest rate portfolio, and how to kind of stabilize the businesses that were now going into really, really difficult territory and were overpriced and had no fundamentals. So at the end of the day, it I think it's pretty individually negotiated versus there being a clear market clearing level, or the nuance between private and public investing.
Yeah, totally makes sense. That's a very nuanced approach, and so like you said, it's a very difficult fundraising environment as well for founders, right? What advice would you give for growth stage founders? Because there is sometimes that gap from maybe seed to series A that is hard to bridge for some founders. There are bridge rounds also happening just to fill that gap. But tell me what it takes to start getting those growth rounds and to start being attractive to growth stage investors. What sort of metrics or numbers should they aim to achieve at what stage to be attractive to investors?
Sure. No, without a doubt. It's a great question. And I think the best way to control your own destiny is ultimately to have revenue speak for itself. And there is obviously an evolution to go from an idea to a product to commercialization to sort of scale to these are all you can't just sort of flip a light switch and say we're all our focus is on revenue now. It has to be validated by the market, and that's fine. But I would say to growth investors, for an earlier growth company, the most attractive thing you can see is a really clean story that one just immediately paints a picture that the product is being validated by the market very quickly. So what do I mean? Whatever we've built, any founder is going to have a very articulate, way to describe what is the product or service, why is it unique, why is the market fantastic, yada yada. That's how they got the seed capital and probably the Series A capital. Um, you know, selling the dream and selling their capabilities ultimately. Um, for it to translate exceedingly well to a growth audience, it's not necessarily showing huge revenue or massive logos or X or Y or Z. I don't really subscribe to that as much. It's showing a very, very clean entry into commercialization. So what do I mean by that? You didn't have to spend a unbelievable amount on team, go-to-market, customer acquisition, going into a sales cycle thing, which maybe is government or enterprise oriented, that is 18 months plus. Like, you didn't need to do these huge leaps just to prove there was a real bid on the product or service. And it's fine if you were really thoughtful about building the team and there is meaningful OpEx to kind of bring on A players. But I want to see at the highest level that the gross margin, even in its infancy, supports that this thing has a lot of room to run, and the channel you're selling into has continuous appetite to keep buying this. So that can mean different things for different segments. But if you can illustrate that really early on, what an investor is going to look and think, they start making the model for you, and they say, okay, if this is what the gross margin expansion profile looks like, if this is what the cohorts are doing, if this is what we know with like in the early days of data, what does 30 million of capital do for this story? And you should be connecting the dots on your own and saying, okay, we can get 20% more efficiency out of that gross margin, or it's selling incredibly well into SMB, pretty frictionless, but that kind of taps out with average customer size. We think the enterprise channel will be super valid for this. And we think it'll actually be a pretty short sales cycle. Maybe it's a 3 to 6 month thing, worst case scenario. So if we invest against that, that gets you from, you think you'll do 10 million in revenue next year. Yeah, you could be maybe 20, but your pipeline could be 50 if we, invest against what you're already doing. So the cleaner the story is, the kind of early signs of really compelling data, that gets people thinking on their own, this is what it looks like with capital. This is what it looks like with scale. And that just makes stories really easy to tell. To flip it on its head, what do you not want to look like? Um, don't, don't have nothing to show for yourself. If it's still truly conceptual, or iterating on the product, or you're selling a dream that there needs to be massive investment for this product to do, the groundbreaking goal it has set in front of it, you're just not giving me anything. You're not giving me anything to build a case around. If you've raised a bunch of safes and seed notes, and you've taken on all this money from probably fancy investors or people from known entities, but if you've spent all your time kind of curating a punchy cap table and the business doesn't reflect any of the use of those proceeds, I don't care at all. That's someone who is playing a fundraising game, and they're optimizing an on-paper valuation, but then none of the fundamental attractiveness of the business is there. And look, it's not to say those people don't like sometimes win and create huge outcomes, and there are founders who are very, very good at playing that game, and then all of a sudden the business starts to commercialize when there's a lot of money being invested, and it goes huge. I mean, the big LLM companies are the best examples of that. They were multi-billion in valuation, and unbelievable amounts of paid in capital before any of them turned on revenue. Now they're the ones leading this next 10-year megatrend, but that's there's pretty isolated examples. There's a lot of opportunities out there, that you're just, if you're getting to a mismatch for the amount of capital you're looking for, it just doesn't mirror what should be, the stage of an attractive, early growing commercialized business. I think that's where people get into trouble, and that's where you can build a mountain ahead of you that's sort of impossible to climb too. If you get away with a valuation that's silly on zero commercial traction, well, you better deliver by the next round. You're going to be in an impossible situation.
Right. Absolutely, completely agree on that. Now, talking about the startup CEO versus the scale up CEO, right? Those are two very different jobs, right? And sometimes founders are able to mature and grow into the scale up CEO as well. Sometimes that doesn't happen, right? So, can you tell me, when you are investing, it's mostly at that junction where that startup is going into that scale up phase, right? So, how are you evaluating the CEO's ability to take up that job? And also, if you gave them a chance and it still didn't work out, then have you had situations where you had to propose that, okay, maybe we onboard a new CEO to lead the scale up effort? So, your views on that?
Sure. Definitely case by case. And it's definitely a very qualitative, sort of subjective topic. It's really hard to paint that with a broad brush and say, this is what always works and this is what you have to do. Um, if you had to generalize, I would say without a doubt, repeat founders are just better equipped. There's just a reality in life, learning as you go. Um, and the product of maybe mistakes in the past or learnings or living through market cycles. I mean, that's a huge reality. This is, we live and work in a space where there's a ton of young leaders and on the investment side too. But there is a reality in anyone's career where you learn as you go, and you're a product of both market cycles, business conditions, macro. All these things happen. These are not just lightning in a bottle companies that are inventing the future and not affected by the outside world. We're all affected by the outside world. It all trickles down. The ultimate source of all of this is the LPs who back us, and they're very affected by the macro in the outside world. So it all trickles through, and without a doubt, repeat founders are going to have great muscle memory. That doesn't mean, I mean, I would, I'm just thinking now in the back of my head, we're probably 50-50 on if we've backed first time founders or repeat, if I'm thinking across the portfolio. And I mean, we've had amazing outcomes with folks that this was their first time in both startup mode, scale up mode, growth mode, and public market outcome. Um, it's There's definitely characteristics you'd look for and you'd hope to see people grow into. We invested in a company called Jackpocket. DraftKings bought them for $750 million last year. It was sort of one of the only M&A trades of the year, let alone a really sizable one. Uh, Run by an absolute street fighter of a CEO, just an incredible guy, can run through walls, highly adaptable, and led to an incredible outcome, and had a business experience, pretty much everything you could on the way up as far as capital formation, growing, went through a really terrible macro cycle, operates in a heavily regulated industry. Look, ultimately got to an outcome that was very large scale M&A, but with a public company too, and it was a cash stock deal too. So everything about that was none of it was easy. Like every stage of the business, getting to the next level and getting to an incredible outcome required a ton of work, and that's someone who delivered in spades. And look, the reality is as well on the other side, it doesn't always work out, and it's never easy. It's never easy. You're an investor alongside a number of other investors in the company, so at a minimum, you have a number of sort of board members and investors monitoring, how the company's doing and how the team that has been that's been built and ultimately was initially backed is doing. And we've seen flavors of this. It's sometimes a bitter pill, and sometimes we've had situations where the founders are very much asking for help and sort of saying, you know, we're at a stage here where I don't, the things that are in front of us, I don't think I'm best suited to learn as I go with. Let's bring in some help. Let's figure out the right way to partner. What should it be? What are the right titles? Yada yada yada. And that's, I think, normal and healthy. But all of these situations are like, specific to the people. I don't think you can generalize any of them.
Right, absolutely. Yeah, thanks for sharing that. And talking about AI, the new mega trend that's there, right? So, how are you using AI within 7GC to do things differently? And how are maybe your portfolio companies using AI to maybe make processes more efficient or try new things internally? So, tell me about that.
Sure. I'll start with the more interesting version, and I'll try to be succinct. I think across the portfolio, I mean, we've invested in core AI technologies, and this is, Anthropic is the largest investment we've ever made as a firm. I think of Anthropic, OpenAI, Mistral, like the sort of private LLMs, and then obviously the open source ones. I mean, I think that war has already been fought, and I think it's almost more like an operating system war. But these are, whether they're open sourced or paid models, and there's pros and cons to both, and sort of applicable users to both. The big ones are here to stay, and they've really set the baseline for pretty much what every engineer and developer should be using. Like we obviously use ChatGPT for more surface level things, and Claude is very multifaceted just for daily use. But the if you look back to, I mean, Menlo Ventures put out this great data point. It's probably a few months old now at their kind of annual summit, and it just broke down what is the consumption of across the board of the large language models. So who is the user, who's doing the most prompts, and who's pulling the most out of it. And it was over 50% was engineers and engineering environments and developers. So what does that mean? One, just as far as the tipping of the scale, and I think this mirrors probably most people's day-to-day life, it hasn't hit the real economy in a major way. It hasn't really reshaped everyone's everyday life. Okay, you're GPTing more than you're Googling, like that's fine. And you and I are probably a bit more tech forward than the average person anyway. But the point being, a lot of what's going on within AI and the best way to leverage the really what are now the winning models, which everyone has the benefit of open architecture around, which I think is going to be really great. There's total interoperability between the paid ones, the open source ones. They're all like very much at a similar kind of bleeding edge scale. And if you are someone within a software company, whether that's a startup or whether it's a large one or whether it's the IT department of Goldman Sachs, you now have access to these basically super brain code assist tools to let you work at a bigger scale, at a more creative scale, lets you manage teams differently. It ultimately lets you build whatever, the solution or suite of solutions or integration with your legacy solutions you need to do. So I think at any company, whether we've invested in them or not, like that has to be the mantra, and that is what's happening. And it's kind of a bit of my critique on what we're calling some of the like agentic AI solutions. That's to me not that's not like an AI company. That's just the new baseline for developing software. No one's going to be making a non AI enabled new software company going forward. Like why it it'd be going backwards. Um, So across the portfolio, there's super interesting stuff. I mean, we've Anthropic's been a fantastic outcome for us. We have another business called Poolside, which is also the kind of code assist LLM specifically for development environments. We have another business called Fluid Stack, which is providing kind of a cloud services layer for access to GPUs and compute. And so they're more like core AI technologies. And then obviously the other businesses we've backed are more apps and services level companies. And I think they're, again, it's just gone into the development work stream. And it's either what's going to be the next generation of what they're building, or how are they just cutting a ton of sort of waste and infrastructure out of things that were built entirely by humans. Uh, in our workflows, it's a little less interesting, unfortunately. Um, Most of the tools we use that are kind of VC specific are very company research oriented. The PitchBook and CapIQ and sort of data services like that, Preqin on on the LP side. And we've been tinkering with kind of they're not all open APIs or fully open. So we're trying to sort of advance the ball on how we can turbocharge some of the services we use. But it's a bit tricky with venture, frankly. And I've heard other people give more eloquent answers to this, and I don't fully understand it because we deal with very opaque data sets and we deal with human interaction. And when we meet companies, it's because I've seen someone I've worked with is on the board and I ask for an introduction to the CEO, and like it starts with lunch. It's a lot of what we do is very kind of offline and person to person. And then the data driven stuff we do, those data sets aren't fully open. I wish I could have Claude ingest everything from PitchBook and I could start asking more dynamic questions, but that'll all change. There's a couple of cool companies out there that are more geared to kind of private equity venture capital, like Rogo in New York is, they've got a pretty cool solution, and I'm sure we'll see more of it. But I hate to say it, I feel like we're more behind the curve than all the companies we're looking at.
Yeah, totally. That's a very insightful answer, and thanks for sharing that. And with that, I'll move to the rapid fire round, wherein I'll ask you six quick questions about the investing you're doing at 7GC, and you have to give six quick answers. Sounds good.
Sure.
All right. So the first one is, what are the sectors and regions you invest in?
So US and Europe, and we're doing AI infrastructure and these days cybersecurity too.
Got it. What's the typical stage of investment?
It's Series A onward, and as long as there is that sort of 10 million revenue threshold level, it's of interest.
Got it. Do you lead rounds?
We do. Um, 50
Okay.
50, depends.
hmm What's the typical check size you put in?
It a wide range, anywhere from $1 to $20 million.
Got it. Where can founders get in touch in case there's a direct way?
Yeah, LinkedIn is probably the easiest, or via our website. Our email links and contact pages are all there. So 7gc.co, or just find us on LinkedIn.
Where can listeners follow you? I believe that'd be the same as LinkedIn.
Yeah, same. I don't have any other kind of social stuff. LinkedIn is definitely the best way to get a hold of us.
Awesome. I'll make sure to put all these links in the show notes below. Thanks so much for making time for this, Jack. Love all the investments you're doing, and here's to more amazing investments.
Oh,
Thank you.
Prashant, thanks so much. I appreciate it. It was nice to chat.
Likewise. Thank you.